Have you ever looked at your investment account after years of contributing and felt like something isn't adding up? You've been doing everything the experts tell you to do. You're investing in index funds, maxing out your retirement contributions, staying disciplined through market ups and downs. Yet somehow, when you run the numbers, you're not on track to be anywhere near as wealthy as you thought you'd be by now. Meanwhile, you keep hearing stories about people who started investing the same time you did, and somehow they've built massive wealth. You're left wondering what you're doing wrong, or if the whole system is just rigged against regular people like you. Here's the truth that's going to sting a bit. Your investments probably aren't making you rich because you're making one or more critical mistakes that are silently destroying your returns. These aren't dramatic failures like putting everything into a penny stock that goes to zero. These are subtle, seemingly small errors that compound over decades and cost you hundreds of thousands or even millions of dollars by the time you reach retirement. The worst part is that most people never realize they're making these mistakes because the damage happens so slowly that it's invisible until it's too late. The financial industry has done an incredible job convincing people that investing is simple. Just put money in index funds, hold for the long term, and watch compound interest work its magic. While that's not wrong exactly, it's incomplete to the point of being misleading. There's a massive gap between knowing you should invest and actually investing in a way that builds substantial wealth. That gap is where most people get stuck, and it's costing them their financial future without them even realizing it. Let's start with the most common mistake that's probably destroying your investment returns right now, and that's fees. You might think you're avoiding fees by investing in low-cost index funds, but the reality is that fees are everywhere in investing, and they're eating away at your returns like termites, slowly destroying a house. The damage is invisible day to day, but over decades, it's absolutely catastrophic. A difference of just 1% in annual fees doesn't sound like much. 1% seems tiny, almost not worth worrying about. But here's the math that will keep you up at night. Let's say you invest $500 per month for 30 years and earn an average 8% annual return. With no fees, you'd end up with about $745,000. Now, let's run that same scenario, but with a 1% annual fee. Your net return drops to 7% and your ending balance becomes about $612,000. That 1% fee just cost you $133,000 over 30 years. That's not a typo. A single percentage point in fees cost you over $130,000 in lost wealth. And most people are paying way more than 1% when you add up all the layers of fees they don't even know exist. Expense ratios on mutual funds are just the beginning. There are trading costs embedded in the fund that don't show up in the expense ratio. There are bid-ask spreads. There are transaction fees your brokerage might be charging. If you're working with a financial advisor, there's their management fee on top of everything else, usually 1% of assets under management. Stack all of these together and many people are actually paying 2 to 3% in total annual fees without realizing it. At a 2% total fee drag, that same $500 monthly investment over 30 years at 6% net return only grows to about $502,000. You just lost $243,000 compared to the no-fee scenario. Nearly $250,000 evaporated into fees. The financial industry loves to focus on gross returns while downplaying fees because they know most people don't understand the long-term impact. They'll show you charts of how the market has averaged 10% returns over the past century, conveniently forgetting to mention that after fees, taxes, and inflation, your real return is probably closer to 4 to 5%. That difference between what the market returns and what you actually keep is where wealth goes to die for most investors. This brings us to the second major mistake that's killing your investment returns, and that's tax inefficiency. Most people think about taxes once a year when they file their return, but taxes are affecting your investments every single day, and poor tax planning can cost you just as much as high fees. The difference between investing in a tax-efficient way versus a tax-inefficient way can easily be 1 to 2% of annual returns, which, as we just saw, translates to hundreds of thousands of dollars over a career. Here's how this plays out in real life. Let's say you're investing in a taxable brokerage account and you're buying actively managed mutual funds that generate lots of capital gains distributions every year. Those capital gains are taxable in the year they occur, even if you reinvest them and never actually receive cash. You're paying taxes on gains you haven't even realized, which reduces the amount of money you have compounding for your future. Meanwhile, someone investing in the same amount but using tax-efficient index funds in tax-advantaged accounts, like a 401k or IRA, is keeping all those gains invested and compounding tax-free or tax-deferred. The tax code actually offers incredible advantages for investors, but most people either don't know about them or don't take full advantage. Contributing to a traditional 401k or IRA gives you an immediate tax deduction, reducing your current tax bill while letting that money grow tax-deferred for decades. Contributing to a Roth IRA or Roth 401k means paying taxes now, but getting completely tax-free growth and withdrawals in retirement. Using a health savings account gives you a triple tax advantage: tax-deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. These accounts exist specifically to help you build wealth faster, yet millions of people either don't use them or don't maximize them. Even within taxable accounts, there are strategies that dramatically improve after-tax returns. Tax loss harvesting, where you strategically sell losing positions to offset gains, can save thousands in taxes annually. Holding investments for more than a year to qualify for lower long-term capital gains rates instead of higher short-term rates can save 10 to 20% on the taxes you pay when you sell. Locating tax-inefficient investments like bonds and REITs in tax-advantaged accounts while keeping tax-efficient stock index funds in taxable accounts optimizes your overall tax situation. These strategies aren't complicated, but they require awareness and intentional planning that most people never bother with. The third mistake destroying your investment returns is poor asset allocation and lack of diversification. This is where things get interesting because there are actually two opposite ways people mess this up. Some people are so conservative that they never take enough risk to actually build wealth. Others are so aggressive or concentrated in a few investments that they expose themselves to catastrophic risk. Both approaches lead to the same result: disappointing long-term returns.
Let's talk about the too conservative camp first. These are the people who keep way too much money in cash or bonds because they're terrified of stock market volatility. Maybe they got burned in 2008 or 2020 and decided they never want to experience that pain again. So they park the majority of their portfolio in money market funds or bond funds earning 3 to 5% per year and think they're being smart and safe. Here's the problem. At 3 to 4% returns, you're barely keeping up with inflation. After taxes, you might actually be losing purchasing power every year. You're not building wealth, you're just preserving capital. And even that's questionable when inflation is eating away at the real value of your money. The math on this is brutal. If you invest $500 per month for 30 years at a 4% return, you end up with about $348,000. Remember, at an 8% return, that same investment grew to $745,000. By being too conservative and scared of volatility, you just gave up $397,000 in potential wealth. That's the cost of letting fear drive your investment decisions. You avoided the temporary discomfort of watching your account balance fluctuate, and in exchange, you sacrificed nearly $500,000 in retirement wealth. On the flip side, you've got the overly aggressive investors who think they're going to beat the market by picking individual stocks or timing when to get in and out of the market. These people are convinced they're smarter than professional investors who do this for a living, with teams of analysts and sophisticated tools. They read some articles, watch some YouTube videos, and decide they've cracked the code on investing. They load up on whatever stocks are hot at the moment, chase performance by buying whatever went up the most last year, and constantly tinker with their portfolio because they can't leave it alone. Study after study shows that individual investors who try to beat the market through stock picking or market timing almost always underperform simple buy and hold index investing. The average investor returns are consistently 2 to 3% below the market returns, not because the market didn't go up, but because they bought high, sold low, chased trends, and made emotional decisions. Over 30 years, underperforming the market by 2% turns that $745,000 into about $557,000. You lost $188,000 by thinking you were smarter than the market. Lack of diversification is equally dangerous. Maybe you work for a tech company and you load up on tech stocks because that's what you know. Or you inherit some stock and keep it all in that one company because it feels wrong to sell what grandma left you. Or you put a huge chunk of your portfolio into cryptocurrency or real estate because you're convinced that's the future. Concentration can create wealth if you get lucky and pick the right thing, but it can also destroy wealth spectacularly when that concentrated bet goes wrong. For every person who got rich holding lots of Apple or Amazon stock, there are dozens who lost most of their money concentrating in companies that went nowhere or went bankrupt. The fourth mistake is closely related, and it's letting emotions drive your investment decisions. The human brain is spectacularly bad at investing because our emotional responses to risk and reward are exactly backwards from what actually works. When the market is soaring and everyone is making money, we feel confident and excited and want to pour more money in. When the market crashes and everything is on sale, we feel terrified and want to sell everything and hide in cash. This emotional pattern of buying high when we feel good and selling low when we feel scared is precisely backwards from what creates wealth. Think about how you'd respond if your favorite store had a massive sale where everything you normally buy was 30% off. You'd probably load up and buy extra because you're getting a great deal. But when the stock market goes on sale and drops 30%, most people's instinct is to run away and stop buying. They're literally doing the opposite of what they do with any other purchase. They're avoiding the discount and waiting for prices to go back up to full price before they're willing to buy again. It makes no logical sense, but it's exactly what the majority of investors do because emotions override logic. The best investment returns go to people who can control their emotions and stick to their plan regardless of what the market is doing. The investors who kept buying during the 2008 financial crisis when it felt like the world was ending made incredible returns. The ones who sold in panic and waited for things to feel safe again locked in their losses and missed the recovery. Same thing in March 2020 when COVID crashed the market. The people who stayed invested or even increased their contributions made great returns. The ones who sold in fear and sat on the sidelines missed one of the fastest recoveries in market history. This is why so many professional investors say that investing success is far more about behavior than it is about picking the right investments. You can have the perfect portfolio of low-cost, diversified index funds, but if you panic sell every time the market drops 10%, you're going to get terrible returns. Meanwhile, someone with a decent but not perfect portfolio who stays disciplined through volatility is going to build substantial wealth. The ability to ignore your emotions and stick to the plan is worth more than any amount of financial knowledge or sophisticated investment strategy. The fifth mistake is not investing enough or starting too late. This one is simple math that most people just refuse to accept. If you're only investing $100 per month, you're not going to build life-changing wealth no matter how good your returns are. Even at a generous 10% annual return, $100 per month for 30 years only grows to about $227,000. That's a decent chunk of money, but it's not going to fund a comfortable 30-year retirement. You need to be investing substantially more, and the longer you wait to start, the more you need to invest to catch up. Time is the most valuable asset in investing, and it's the one thing you can never get back once it's gone. Someone who starts investing $300 per month at age 25 and earns 8% annually will have about $1 million by age 65. Someone who waits until age 35 to start needs to invest nearly $650 per month to hit that same $1 million by 65. By waiting 10 years, they need to invest more than double the monthly amount to reach the same goal. Wait until 45 and you'd need to invest over $1,500 per month. The math gets progressively more brutal the longer you delay. This is where the excuses come in. People say they can't afford to invest more right now. They'll do it when they get a raise. They'll catch up later when they're making more money. But later never comes because lifestyle inflation eats every raise and there's always some reason why now isn't the right time. The people who build wealth are the ones who make investing a non-negotiable priority from the very beginning. They invest first and live on what's left, rather than living first and investing whatever happens to be left over, which is usually nothing. The sixth mistake is ignoring investment costs beyond just fees, particularly opportunity costs and inflation. Opportunity cost is the return you're missing out on by making one choice instead of another. If you keep $50,000 sitting in a checking account earning nothing because you like seeing that big balance, the opportunity cost is what that money could have been earning if it was invested. At 8% annual returns over 20 years, that $50,000 would grow to about $233,000. By keeping it in cash, you gave up $183,000 in potential growth. That's a massively expensive decision, even though you didn't lose any money on paper. Inflation is the silent killer of investment returns that most people completely ignore. If your investments return 7% per year, but inflation is running at 3% per year, your real return is only 4%. That difference matters enormously over long time periods. At 7% nominal returns, $500 monthly invested over 30 years grows to about $607,000. But in today's dollars, adjusted for 3% inflation, that's only worth about $250,000 in purchasing power. You didn't actually build $607,000 in wealth, you built $250,000 in wealth. The rest was just keeping up with rising prices.
This is why investing in low-return, safe assets like CDs and savings accounts feels safe, but actually exposes you to inflation risk. You're not losing money in nominal terms, but you're losing purchasing power in real terms. Over long periods, this inflation risk is far more dangerous than the volatility risk you're trying to avoid. The stock market might fluctuate wildly in the short term, but over long periods, it has consistently outpaced inflation by a significant margin. Cash and bonds provide stability, but they often barely keep up with or sometimes even lag behind inflation after taxes. The seventh and final mistake is lack of a clear plan and specific goals. Most people invest in a vague, general sort of way. They put some money in their 401k because they know they're supposed to. Maybe they open an IRA and contribute when they remember to. They buy some stocks here and there when they have extra cash, but they don't have a clear target for how much they need to accumulate, by when, or what specific return they need to achieve to get there. This lack of clarity makes it impossible to know whether you're on track or falling behind until it's too late to fix it. Investing without specific goals is like getting in your car and driving without a destination. You might end up somewhere eventually, but it probably won't be where you actually wanted to go. You need to know exactly how much money you need to accumulate to fund your desired retirement lifestyle. You need to calculate how much you need to invest monthly to hit that target based on realistic return assumptions. You need to track your progress and adjust if you're falling behind. This requires doing actual math and planning, which most people avoid because it feels boring or overwhelming. The people who build substantial wealth through investing aren't lucky or smarter than everyone else. They're the ones who took the time to create a specific plan, calculated exactly what they needed to do, and then executed that plan consistently for decades, regardless of market conditions or how they felt in the moment. They minimized fees, optimized taxes, maintained appropriate diversification, controlled their emotions, invested enough from the beginning, and stayed focused on their long-term goals instead of getting distracted by short-term noise. So there you have it. Your investments aren't making you rich because you're paying too much in fees, ignoring tax efficiency, getting your asset allocation wrong, making emotional decisions, not investing enough or starting too late, ignoring opportunity costs and inflation, and lacking a clear plan. The good news is that every single one of these mistakes is completely fixable starting right now. You can switch to low-cost index funds to slash your fees. You can maximize tax-advantaged accounts and implement tax-efficient strategies. You can create a properly diversified portfolio and commit to never touching it based on emotions. You can increase your contribution rate and automate it so it happens every month without fail. You can create a specific plan with clear goals and timelines. None of this requires special knowledge or connections. It just requires awareness of what actually matters and the discipline to do it consistently. Fix these mistakes and your investments will start working the way they're supposed to, building real wealth that transforms your financial future instead of just spinning your wheels and going nowhere.